I just got back from a 3-week vacation with my fiance to Spain, and over my vacation, I received so many comments about Equitable Bank, its most recent earnings, the current share price performance. So in today's video, I'm going to be answering your question of, is Equitable Bank looking cheap today, and why is the stock down after it reported its earnings? So with that being said, let's waste no time and just hop right into the Daniel Pronk slideshow that I have for you today. So let's start off with Equitable Bank's most recent earnings report, which was its Q1 2024 earnings. And this says, EQB delivers 12% year-over-year earnings growth, increases dividend by 5% quarter-over-quarter and 20% year-over-year. So right away, it looks like Equitable Bank did grow its earnings 12% and its dividend by 20% year-over-year. So seems like a pretty strong earnings so far. Then we can see down here that revenue is up to $299 million, which is up 27% year-over-year. And adjusted EPS came in at $2.76, which again is up 12%. Book value per share also increased by 14%, and the common share dividend again increased by 20%. And this one is what I really like to see. So Equitable Bank increased its customers by 6% quarter over quarter and 38% year over year to 426,000 customers now. This is very strong growth to Equitable Bank's overall customer base. Then we can see the total capital ratio came in at 15.4%, which is very good and does show that the bank has a lot of liquidity, and that's well above regulatory requirements. Now here we can also see that revenue came in at 299 million, whereas last quarter it was 395 million. Now, I did see some people say that this was bearish, but Equitable Bank's last quarter was actually 4 months because they are changing their corporate calendar year to align with the other Canadian banks. So their last quarter was actually 4 months instead of 3, which is why the revenue and the net income are so much higher. So the best comparison that we have right now is actually versus the fourth quarter of 2022. And here we can see that revenue was 235 million and net income was 92 million. So overall, Equitable Bank is growing pretty strong year over year. Now, another thing that I saw people talking about was Equitable Bank's shares outstanding, because it did grow by about 3% year over year. Now, Equitable Bank does do some dilution when it wants to acquire other businesses. They recently did an acquisition of ACM, which gave Equitable Bank $5 billion in additional assets under management. And they did dilute shareholders a little bit to help afford this acquisition. Now, personally, I don't mind this that much because on a per share basis, earnings are still growing. And on a per share basis, earnings did grow by 12% year over year. So despite the dilution, there is still significant shareholder value being created. Now, if they were diluting and that was causing their earnings per share to grow by like 5% or maybe even decline year over year, then that would be a much different story. But since Equitable Bank is diluting and still growing EPS by double digits, I am going to give them a pass on this one. And this isn't really significant dilution, okay? It's a little bit of dilution to get a pretty high quality business that is already adding to EPS. So now let's go back and talk about the provisions for credit losses. So here we can see that for the most recent quarter, again, it was 15.5 million. And then on an adjusted basis for the fourth quarter of 2022, it was about 7.8 million. This means that the provisions for credit losses increased by 100% year over year. And I saw a lot of people saying that this was very bearish because what banks do is they put aside capital for future credit losses or for loans to go bad. So seeing the provisions for credit losses double year over year is suggesting that maybe Equitable Bank has a lot of loans that are about to go bad. And this could mean that the bank is going to see a lot more losses in the future. Now, personally, I am not that concerned about a $15.5 million provision for credit losses expense on the quarter. And this is naturally going to go up as Equitable Bank expands. And I would actually argue that in the fourth quarter of 2022, this was artificially low, this $7.8 million expense. There was a period of time when interest rates were lower that there was not really loans going bad and banks were not putting aside a lot of capital for provisions for credit losses. Now I think that it is kind of normalizing, and this is still not that much capital that Equitable Bank is putting aside. So for me, this is not really a red flag yet. If this spiked up to like $50 million, then I would be a lot more worried, but I'm not worried. Now, moving on to the credit quality. This is the number one bearish point that I saw online for this quarter. And when I read this quarter's transcript, this is what analysts were really hammering on. So I do think that this is what the sell-off was caused by. And this is the net impaired loans as a percent of total assets. And we can see that for the first quarter, it came in at 0.94%, so almost 1% of the loans. We can also see that in the second quarter of 2022, it was actually all the way down at 0.18%, and it has been increasing every single quarter since then. and now again it is at basically 1%. Now, if we take a look at the net allowance for credit losses as a percent of total loans, it's only 0.2%. So basically, Equitable Bank is not putting aside as much capital for loan losses as they're actually losing on their loans. And I did see some analysts asking, why is this? Why are you not increasing the amount of capital that you're setting aside for loans to go bad? And we are going to discuss why this is a little bit later on in the video, because the CEO did give a really good response in the transcript. Now, another reason why I think the share price dropped after earnings is because of this right here. So the common share price before the earnings was $92 per share, and the book value per share for Equitable Bank was $71.33. This means that Equitable Bank was selling for a price to book of around 1.4 to 1.5, which is pretty high for this bank, at least relative to how it has traded historically. For example, if we take a look at the third quarter of 2022, the common share price, or the share price, was $46, and the book value per share was $61. So Equitable Bank was trading for a price to book of about 0.7 at that time. And then the share price increased dramatically. It basically doubled, while book value per share only increased by about $10. So the share price ran faster than the book value grew, basically. And I do think that the stock is correcting and getting back down to its historical averages based on this. Now, this next slide comes from Equitable Bank's earnings presentation, and this shows what is going on with the overall provisions for credit losses. So this says equipment financing business accounts for approximately 2% of the bank's total loans. Provision for credit losses from equipment financing accounted for over 80% of net PCL, or provisions for credit losses, for the first quarter, or $12.7 million. Losses were largely a result of cyclical downturn. So that large increase to Equitable Bank's provisions for credit losses came from only 2% of the bank's total loans under management. And it is really isolated to their equipment financing loans, which are higher risk loans. So that is a small portion of Equitable Bank's overall portfolio that is starting to have some losses in it, which again, I don't think is a very big deal. Now, moving on, we can take a look at Equitable Bank's different loans and the loan growth year over year. So right here, we can see that single family mortgages actually declined by 8% year over year. So Equitable Bank is not writing as many single family home mortgages. However, decumulation loans are up 55% year over year to a portfolio of about $1.6 billion. And this business is growing very quickly, and this is a brand new business for Equitable Bank. Commercial loans also increased by 10%, and insured multi-unit residential mortgages increased by 55%. Overall, total loans under management increased by 12% year over year. And I do think that Equitable Bank is going to continue growing its loans under management by around double-digit growth rates going forward, which is very good for a bank. But in this slide, you can overall see where Equitable Bank's growth is coming from. Now, moving on to Equitable Bank's cash flow statement, there's a few things here that I want to point out that I do really like. So overall net income in the quarter was $104.4 million. Now, if we take a look at stock-based compensation, it is only $1 million, which is less than 1% of Equitable Bank's net income. As you guys know, I love businesses that do not do a lot of stock-based compensation. And I think that this is a very low amount of stock-based compensation. So Equitable Bank is not diluting their shareholders to pay management, which I do love to see. Then down here, we can see that the dividends paid on common shares was only about $15 million. Now, if we compare that to the $104 million of net income, it means that not a lot of Equitable Bank's earnings is going to paying the dividend. And this is why Equitable Bank can continue to grow its dividend at 20% annually, because there is still a lot of earnings left over that they can pay out as a dividend. And additionally, the earnings are growing by double-digit growth rates. Now, Equitable Bank is wanting to grow its dividend by 20% annually, but I do not think that earnings are going to grow at 20% annually. So what this overall means is that Equitable Bank's payout ratio is probably going to increase over the coming years, while they are increasing their dividend more rapidly than the business's earnings are growing. But overall, the dividend here is very, very safe, and it has a lot of room to continue growing. So now let's move on and talk about Equitable Bank's most recent acquisition. So this says, on December 14th, 2023, EQB acquired 75% ownership in ACM, who has nearly $5 billion in assets under management. The existing management team of ACM has retained a 25% ownership. So when I'm looking at this business, I am seeing highly incentivized insiders and management because they still own 25% of ACM. So they're going to want to see this business grow. EQB paid $86.5 million in total. So this was the purchase price of the business. From the date of the acquisition to January 31st, 2024, ACM has contributed $2.6 million of revenues and $1.5 million of profit before taxes to EQB's financial results. Now, this is only a month and a half of revenue and earnings since EQB acquired this business. So on a 3-month basis, what we can actually do is multiply these values by 2. So 2.6 times 2 is $5.2 million in revenue. And then we can times that by 4 to see an annual basis. So on an annual basis, ACM is doing about $21 million in revenue. Now, if we do the earnings for this business and do the same thing, we can see that it produces about $3 million in earnings per quarter. And if we multiply this by 4, that is $12 million in annual earnings. Now remember, Equitable Bank paid a price of $86 million for $12 million of annual earnings. So what we can do is go 86.5 divided by 12 means that Equitable Bank paid a price to earnings ratio of 7.2 for this business. Now, in my opinion, this is a very low purchase price, and it means that Equitable Bank got a high yield on this business. So when Equitable Bank does do acquisitions, they like to do them at low prices and high yields to the shareholders. And this is why the earnings per share grows despite there being slight dilution from acquisitions. I think that this was a really good acquisition on Equitable Bank, actually. And they do want to double ACM's business and its profits over the next 5 years. Now, this was surprising to me here. So on this slide from the investor presentation for Q1, Equitable Bank is reaffirming their 2024 guidance. They're still projecting earnings per share to come in at $12 for the year of 2024. They want to grow the dividend again by 20 to 25%, which as we saw, they can definitely do. And they want to grow book value per share by about 14% year over year. Additionally, they want to grow their customer base by 30 to 40%, which they are on track to do already, with 38% year over year revenue growth already. So Equitable Bank reaffirmed their previous guidance, but despite them reaffirming their previous guidance, the stock still dropped. But in my opinion, them reaffirming guidance is basically saying that nothing has changed when you look at the full year outlook. Now, very quickly, Equitable Bank is trading for a price today of $82 per share Canadian. So if they do actually do $12 per share in earnings like they are projecting this year, then the stock is trading for a price to earnings ratio of about 6.83, which I do think is very cheap for this business. They also put out this slide right here, which shows that there was a total shareholder return of over 1,000% since Equitable Bank did become a public company in 2004. So over the past 20 years, Equitable Bank has delivered over 10x returns with a total shareholder compounded annual growth rate of 13% annually, which has outperformed the S&P 500. Equitable Bank is on track to achieve the best 20-year total shareholder return of any banks listed on the TSX and the S&P 500. So they are outperforming Royal Bank of Canada, TD Bank, JP Morgan, Bank of America, everyone else. Equitable Bank has literally been the best performing bank on both of these major indexes, again providing 10x returns over the past 20 years. All right, moving on to the transcript now. So this is from the CEO, and he says, "We also expect provisions for credit losses to moderate in the second half of the year." Now, what he is saying here is in the second half of the year. So I do think that the second quarter or next quarter could still see elevated provisions for credit losses, which may cause analysts to become a little bit more bearish. But in the second half of 2024, he is saying that everything should be back to normal. Then later on, he says this, "There is a big pressure on some of our customers, which has resulted in elevated default rates. The PCL is mostly due to lease originations from 2022 vintages, more generally across the commercial book, but getting increasingly comfortable of our commercial portfolios impaired will start to normalize in the second half of this year as we reach the resolution of larger commercial loans. In fact, already in February, $55 million has been resolved or made current, and we have a plan to exit the vast majority of these loans with full recovery on many of them." So the reason that Equitable Bank's PCL is not growing is because they are actually getting their money back from these loans that have gone bad. So basically these loans are actually being repaid, and so far in this quarter, $55 million of these bad loans has actually been repaid from their customers. And they do believe that going forward, more and more of these loans are going to be repaid. Now, I do have some other final thoughts here that I do want to talk about in this video that weren't necessarily in Q1. So EQB is launching a small business account this year that will allow small businesses to bank with EQB earn higher interest, and save money. Now, I cannot wait to see the bank roll this out. And the reason for this is because EQB has also said that a lot of its customers are entrepreneurs, which means they already have small businesses and bank with EQB. So moving their business accounts over to EQB as well will probably happen. I mean, think about it. If you are an entrepreneur who has a personal account with EQB and you're getting high interest on your money, then why not move your business accounts over to EQB and get high interest on the money as well? I think that this could provide solid long-term growth for EQB, and I think that they will be successful in this pursuit of small business accounts. Additionally, I think that this quarter and potentially next quarter could be one-offs, but over the long term, I do see this bank continuing to grow very well. I have no idea what the stock price will do over the next 3 to 6 months, especially if next quarter is actually a weaker one as well. But if EQB does fall further, then it will just offer a higher earnings yield and more long-term returns, in my opinion. I also think the housing market in Canada is going to pick back up, especially if interest rates do drop. So mortgages and mortgage loans should start to increase for EQB as well. Now, one thing that I also found really interesting is when I was analyzing EQB, I did notice that the stock tends to follow its quarterly earnings, not its trailing 12 months earnings. And I'm going to show you what I mean. So if we go to earnings and remove free cash flow and go to quarterly, and then also add in EQB's stock price here, we can see that when the quarterly earnings drop, so does the stock price. Right here, for example, in the first quarter of 2020, well, that was the overall stock market crash, but earnings did drop and so did the stock price. And then the quarterly earnings did drop here in 2022 and the overall stock price did drop. Now we can see that the quarterly earnings did drop in the most recent quarter and the stock price has dropped as well. However, when we change this to a trailing 12 months view, we can see that earnings overall have steadily continued to increase and are now hitting an all-time high. So it seems like Equitable Bank stock is very reactive to what the quarterly earnings are doing, but it is not very reactive to what the trailing 12 months or the long-term earnings are actually doing. So when the quarterly earnings do drop like this, I do think that it can provide a cheaper price to enter EQB on or potentially add to my position on. And I have been adding to my Equitable Bank position around that $80 per share mark. If we also take a look at Equitable Bank's price to earnings ratio right now, we can see that it is sitting at about 6.66, and the historical average over the past 13 years has been about 7.6. So the price to earnings ratio right now is below historical averages as well. And I do like to see that, and I do think that this is giving me a good chance to continue increasing my EQB position. EQB is also selling for about 6.8 times 2024 earnings, which is a 14% earnings yield, while the business is still growing. So a 14% earnings yield, that is how much the business can actually produce for me as the shareholder. And then this yield should grow over time with the overall business and its earnings as well. So that is why I think that the stock is cheap, because when I take a look at what the business behind the stock price can deliver to me, as the shareholder or as the owner of the business, it is a very high yield that is actually above the historical returns of the S&P, and this should continue to grow over the long term. So I think that this is a very, very nice price. And again, over the long term, I do think that EQB will continue to grow. So I have added to my position and I will continue to dollar cost average this business, especially if the stock price comes down more or stays near that $80 per share range. I simply think that this is a very high quality business that will continue to grow over the long term. So that is my opinion on Equitable Bank right now. That is what I am doing with my position. I hope you guys enjoyed this update. I know it was kind of late. The business did report earnings like 2 weeks ago. But again, I was in Spain, I was on vacation with my fiance, and I just wanted to take a little bit of a break from posting videos. The videos that I did post were backlogged, so I made them before I left, and then I posted them over time when I was on vacation. From your perspective, it probably looked like I was not on vacation, but I was away. But anyways, that's my thoughts on Equitable Bank. I am continuing to add to my position. I think that it's going to be fine long term. Next quarter may have some slight increase in losses or whatever. The analysts may be upset about that, I don't know, but over the long term, I do think that this bank is going to continue to grow, which means that the share price should also grow with the earnings. And that is going to wrap up the video for today, everyone. So if you did enjoy this video, then please remember to leave a like on it. And if you're new here and you want to see more stock market related content like this, then please consider subscribing to my channel as well. But that's going to wrap everything up. So thank you all again so much. I truly do appreciate it. And I really hope to see you all again in my next video.